Hi, this is Markus with Rockwell Trading, and in this video we're going to take a look at two things: why buy put options and how to place contingency orders. Two things that I think are important, especially when trading the power crossover method. So here we have a chart of Nike, and we see that Nike's actually given us some great signals this year. At the beginning of the year, we had a nice downtrend identified by the power crossover method downtrend rules. We had a nice uptrend that began in February, February 11th to be exact, and had a nice move higher. And now we're starting to see signs of another downtrend. We have all three indicators based on the power crossover method bearish, and we see that yesterday we had what we call a signal day. So the market is in a downtrend based on the power crossover method rules. Now today we're looking to see if we have a trigger day. We see that the price of the stock is currently at $73.90, and the trigger in this case would actually be if the market trades at 73.58. The low of this bar is 73.59, so that's why our trigger is 1 cent below the prior session's low. Now, we could do this in two ways. One, we could short sell shares of the stock, and as a trader, I think that it's great when we have the opportunity to profit from a market that is rising and also to profit from a market that is going down. That way we don't just have to rely on markets or stocks that are moving higher. And short selling is okay, but there are some drawbacks. You see, when you go to sell shares of stock that you do not own, they have to be borrowed, and your broker looks for those shares. Sometimes, depending on the stock that's being traded, you might have additional costs. If there's a hard to borrow list where it's very difficult to locate those shares, you could pay more to initiate the transaction, or your broker might just reject the order and say unable to locate shares, and it might be a great move that you missed out on simply because your broker was unable to locate those shares. With a put option, you do not have those concerns and issues. If you're new to options, it's pretty simple. As an option trader, you can buy or sell options, and if you are an option buyer, you are paying for rights. So I would encourage you to first start at looking at what happens when you are an option buyer, just to get started with things. Stick with the basics if options are new to you, but the two option classes, the first being a call option. If you buy a call option, you are paying for the right to buy stock at a certain price. So like back here with this uptrend, this day here, the high was 74.14. So maybe as an option buyer, you wanted to buy the 75 strike, which this is the $75 mark. And it didn't matter if this stock moved up to $80, $90, $150. If you had the right to buy stock at $75, then that's the right that you have as a call buyer. Now, options do have expiration, so that's something that you also have to factor in, how long you have that right. But that's the gist if you are buying calls. Now, you could also buy a put. And as a put buyer, you have the right to sell stock. So as a call buyer, you have the right to buy stock. As a put buyer, you have the right to sell stock. Well, why would you want to sell stock? Well, especially if you think that the market's going to be moving lower. If you think that you could pay for the right to buy stock at $75 and it's going to go down to $70, but it's just not there yet, then you have the potential to make money on that way down. So buying puts is very easy, and you don't have the limitations or potential restrictions or additional costs that might be associated with short selling stock. So that's why I love put options and options in general. And the next question is, well, how do we do this? How do we buy a put, and how can we put an order in the market that will be initiated if this power crossover sell signal is actually triggered? And let me go ahead and bring up the Chicago Board Options Exchange, CBOE. The CBOE gives us a great virtual tool. So if you're completely new to options, and this would be a great way to get some practice and to train, under their tool tab, you'll see that there's a virtual trade. You could click on that and then sign up, and you could bring up the virtual tool here. Now at the top you'll see these green tabs, and under quotes you can bring up an options chain. So let's go ahead and do that. There we go. And it defaults to the SPY, but we're going to look at Nike, so we will update that symbol. There are a few options here. The range, you could keep that near the money for the type of trading that we're doing. You could bring up calls, puts, different combinations depending on the strategy that you're looking at. For now, just basic calls and puts. And then the expiration, this is up to you. We talk more about expirations and the option to select in our how to swing trade options DVD and in the Rockwell Club, but for now we'll just stick to the April 2014 expiration, and I'm going to click on View Chain to bring up this options chain. Now as you scroll down, it's going to show you the weekly options first. So we have the March week 4 options chain. This expires in a couple of days, so that's not what we want. We have the first week of April. We do not want that. Second week of April, we do not want that. And here we have the April 2014 calls, and this would be the April 2014 puts. So the calls are on the left side, puts are on the right side, and in the middle you have strike prices. So with every option that you purchase, there will be a strike, and the strike is the price that you have the right to buy stock at. If you are buying a call, the strike price is the right, or the price that you have the right to sell stock at if you are buying a put. So puts are on this side. You see that this is the last price traded, the change in price, and here we have the bid, the ask, volume, open interest. For the type of trading that I do with the power crossover method, we don't need to worry about these other things, and we're going to focus mostly here on the bid and the ask. So if you're new to the bid and ask, what it means and why it matters, think of it this way. If you want to buy this option and you do not want to haggle for the price, then you are going to buy at the asking price. Right? It's kind of like going into a car dealer. They might have $10,000 on a used Chevy Tahoe, let's say, and you can try and get a lower price, but in getting a lower price you might miss out on that opportunity. Someone might come along and buy that vehicle from you, or you could just say, hey, I'm gonna pay the asking price and it's a done deal, don't need to worry about it, I got what I want. There you go. Same idea with the ask and the bid. If you are a seller, if you, talking about a used car lot again, let's say that you have a trade-in vehicle, you have like I don't know, an old 2000 Honda Accord, and you want to trade it in, then the dealer says, hey, I'll give you 4,000. That's what we're willing to pay. You could try to haggle and get more for that, but they might say, nope, no thank you, get out of here. Or you could just take what they're willing to pay, and that is the bid. Same goes for options trading. The bid is the price that you will get if you are selling, and the ask is the price that you will pay if you are buying. You can be more selective here and use limit orders to try and split this difference or shave a few pennies off this price. For the orders that I would put in for the power crossover method, a rule of thumb for me is if I see that this bid-ask difference, which is known as the spread, if that is less than 10 cents, I'm not too worried about using a contingency order. If it's greater than 10 cents, if we have these real wide spreads here between the bid and the ask, then I might be more selective with how I choose to get into the market. But for now, we could just use a market order and a contingency order. So we can actually click trade here if we wanted to select the 75 strike. And again, selecting the option itself is something that we do cover in our How to Swing Trade Options DVD, and how that all ties in with the power crossover method. But in this video, I want to look at how to use contingency orders, because what we could do here is if we just submitted a market order, then we're going to get in, we're going to buy this put, but if the price of the stock never trades through the prior session's low, then we do not have a valid sell signal. So if we just use a market order now, we might get into a trade that technically we should have never been in. So here with this order, buy to open, the April 2014 75 strike puts for Nike. We'll just use one being the quantity right now. Here we see the bid, here we see the ask. Again, we're going to buy at the ask, and if you're new to options, basically the quotes for an option are per share, but then every option contract is based on 100 shares. So if you have a quote of $1.92, that's per share. You multiply that by 100, so basically you're paying $192 for this 75 strike put. And remember, by buying the 75 strike put, you are paying for the right to sell Nike at $75. Now, here is where we can use an advanced order and select contingent order, and this is what we want to do when trading the power crossover. Going back here, we see that the current stock is at $73.86, but we want to get into this position if this move goes below the previous day's low or the signal day's low. So with the contingency order, we can set this as a criteria. You see, under contingent criteria, this order will be placed upon meeting the following criteria. The trigger, you could base that on price, time, or volume. We're using price. And the symbol being Nike. And here's the criteria. The trigger will occur based on price if the last price is not greater. We'd use greater if we expected the market to move higher, but less than, and since the low of the previous day was 73.59, this is the price that we'll use, because we want this to trigger if the last price is less than 73.59. So basically, if the last price is 73.58 or lower, we could use this as good till canceled or day order, doesn't really matter. And we could, here you could choose the different times, like maybe you don't want it to be triggered in the first 10 minutes of trading. That's up to you. But we'll just keep that unselected right now, and I'll click preview order. We could look at the order. So we're looking to buy to open one Nike April 2014 75 strike put. Day order, we could also use a good till cancel order, since this order could be in the market for 3 days. We'll cancel after 3 days, but we're hoping that it will be triggered in 3 days. And the contingency is this order will be sent, which is a market order. This market order will be sent if Nike is less than 73.59, and that is how we can send an order to the market to be triggered based on a power crossover method signal. So this is how to place contingency orders, to have orders in the market ready when a signal and potential trigger occurs. And again, for trading these moves lower and for downtrends using put options, you don't have to worry about locating shares of stock. You don't have to worry about additional costs associated with hard to borrow stocks or shares. And you don't have to worry about the potential for the order to be rejected because shares could not be located. So those are the benefits of using put options instead of short selling stock, and how to place a contingency order in the market to be triggered when we have a power crossover method, sell signal, and trigger.